HMRC is facing growing criticism after admitting a major state pension tax error that could potentially affect around 1.7 million pensioners across the United Kingdom. The issue centers around how state pension income has been automatically calculated inside self-assessment tax returns, and experts now believe many pensioners may have been shown incorrect amounts that are higher than what the law actually requires. The controversy started after a retired taxpayer reportedly contacted tax expert Mike Warburton questioning whether HMRC was calculating state pension tax correctly. At first, it sounded like a small technical issue. But once the figures were investigated more closely, the situation quickly became much bigger. According to reports, the problem involves the difference between when pension payments are physically received versus when pension entitlement officially accrues during the tax year. Under Department for Work and Pensions guidance, state pension income for tax purposes should be calculated based on the amount a person was legally entitled to receive between April 6th and April 5th of the tax year. That may sound simple, but the timing creates an important difference. The guidance reportedly explains that pensioners should count 1 week at the old pension rate and 51 weeks at the new updated rate. However, investigators discovered HMRC had allegedly pre-populated many self-assessment tax returns using a flat calculation based on 52 weeks of the newer, higher pension rate instead. That means some pensioners may have had slightly inflated pension income figures automatically inserted into their tax returns. And because self-assessment systems are often trusted by users, many people may never have noticed the discrepancy at all. After the issue was raised publicly, HMRC admitted the mistake. In a statement, HMRC apologized and confirmed that affected pensioners can manually amend the pension figure before submitting their tax returns. The agency also acknowledged that anyone who believes they overpaid tax because of the error can request a repayment. According to HMRC, the financial impact is usually relatively small, reportedly around £5 in extra tax for many cases. But even though the average amount may seem minor, critics argue the bigger issue is trust and accuracy. Because when an official tax authority pre-fills information incorrectly for nearly 2 million people, it immediately raises concerns about how many pensioners may unknowingly pay the wrong amount of tax. And for older retirees living on fixed incomes, even small mistakes can become stressful. The situation has also sparked wider criticism of the complexity surrounding pension taxation in the UK. Many pensioners already struggle to understand changing tax rules, frozen thresholds, and state pension reporting systems. Some retirees rely heavily on HMRC's pre-filled tax information because they assume the government calculations must automatically be correct. Now, experts are warning pensioners to carefully double-check their state pension figures before submitting returns. The controversy arrives during a period when pension taxation is already becoming a politically sensitive issue across Britain. More pensioners are gradually being pulled into income tax because state pension payments continue increasing while the personal tax-free allowance remains frozen. That means even relatively small changes or errors can affect a growing number of retirees every year. Some critics are now calling for HMRC to completely review how pension information is automatically processed in self-assessment systems to avoid future mistakes. Others argue the incident highlights deeper problems with the UK tax system becoming too complicated for ordinary people to manage confidently. At the moment, HMRC says affected individuals can simply correct the figure themselves before filing their return. But for many pensioners, the fact that the mistake happened at all is already causing frustration and concern. And with around 1.7 million self-assessment pension returns potentially impacted, the issue is now becoming one of the biggest recent controversies involving HMRC and state pension taxation in the UK.